Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim, and Happy New Year.
Thank you for having me, and a Happy New Year to you.
How would you characterize the year 2021?
Technically speaking, I would say razor's edge. Razor's edge. The greatest mania, I think, of all time as we go into 2022. It continues to walk that razor's edge. Looking at equities, there was a half-hearted attempt for a peak back in August, but the setup it didn't bite. It turned out to just be a stumble. The structure there was an attempt at a structural setup, but like I said, it just didn't quite take hold. And now here we are. At the end of the year, we're once again beginning to see some cracks, and the focus as we move into 2022 is whether we can see a setup that actually takes hold and bites. I think the bigger threat as we move into the new year is not of inflation, but of a debt-based deflationary collapse of all asset prices. If you simply stop and think about it and look at the evidence, the actions of the Fed, this debt-based spending spree, the expansion of government debt, all of that is evidence that something is not right. It's all in an effort to keep the bubble. It's the tool to keep this thing going, and so the very actions are these very actions by the Fed and the government are to me obvious evidence that they're very much aware of the problem and what's going on. And for example, we talked about, remember back in, I don't remember now exactly, April, May, we started seeing the ramping of the reverse repos in an effort to put a floor under short-term equities, and that started out at 300-400 billion a day, and the next thing you know, we're at half a trillion, and then we escalate to 750 range, and then all of a sudden, remember we made the comment $1 trillion a day to keep the bear market away. Well, we've crept up, and now today I happen to check the numbers, and it's at 1.9, so $2 trillion a day to keep the bear market away. And so all these are efforts. If you look at it, granted, on the one hand, yes, this thing it's walked the edge, it's still intact, but it's still the ginormous bubble that it is. But all these efforts are telling us that, I think it's a sign of the bubble. It's that simple. But all the while, you look at the engineered supply chain shortages and that sort of thing. It obviously has driven prices up. Obviously, that's resulted in inflation. I mean, the price of food and et cetera, everything. Lumber. I mean, you name it. Car parts. It doesn't matter. But that's all served, I think, to camouflage the threat, the real threat. And we're being, of course, the focus is on the immediate, which is the inflation. And I think the High Wire Act as we go into 2022 is going to be how well the efforts to keep it all together, like we've seen here this year, fare versus the natural deflationary forces for it to unwind. Once we get a structural setup that bites. I mean, every bubble, every top, every bottom, every turn of every cycle of every degree has to have the proper structure for that turn to take place. And that's the part of I said razor's edge. That's what we've walked all year. It'll try to bite, something will try to bite and it won't, and it'll try and it won't. And so the key from my seat, technically speaking, looking at the cycles and the structure of the cycles, is the structure. And once we see structure that bites, then we're at great risk of the unwinding beginning, and I think it will once we get a solid setup. At present, again, there are some cracks, and the key is whether these cracks are mended and keep the bubble going, or if they begin to spread and we begin to see something more take hold here. Once it bites, I think that it's, and the real unwinding begins, I think it's going to dwarf anything we saw in 2020 or 09 or 2000 or even 29. Like I said, it's in my eyes, and I think it's hard to deny this, but this is absolutely the largest debt-based asset bubble in history. And that's what we're dealing with. And like I said, the razor's edge and recapping it is the battle, the fight, if you will, to keep it alive. And that's where we sit.
Tim, you mentioned some cracks are appearing. Where are those cracks?
Well, I'm seeing it with some of the leading indexes and some proxy indexes, cyclical proxies that I see, or that I have created, to reflect the cycles. One of the leading indexes is, for example, the Amex. Looking at another one, I see some cracks in some of the commodities. I see some cracks in, the Baltic Dry Index. I see, now, will these materialize into, in other words, do they spread into the other indexes and sectors and bite, or are they once again mended? I don't know. That's what we have to monitor and see.
Mm-hmm. Now, the Baltic Dry Index, for people who don't know, that's the amount of goods being shipped by ships, right?
Yes.
And of course, we're talking about supply shortages. Some saying, factories that were shut down due to the COVID panic, or other reasons, or not enough storage space on docks or in docks, around docks. I think somebody pointed out to me after Biden said, the Port of LA has to work 24 hours. It's simply because shipping companies were using the port as a storage facility and not as a place to move goods. And now the big push in real estate is to buy warehouse or rent warehouse space around all the major ports. So that's, a move there, but you almost feel that some of these supply shortages are contrived. And I wonder, since supply shortages drive up prices, why should I, as a producer, produce enough goods? I get much more money when I make just a little too less or too little to meet the demand. I make more money that way. Why should I make enough cars or make enough refrigerators or make enough food?
Well, and you're exactly right. And that I think is, when I said engineered, that's part of what I was talking about. I've seen that. That is, you're absolutely right. It is the illusion which makes it, you said it as well as I can. That in and of itself drives prices. And we are seeing that. No question about it.
We'll have more with Tim, Cyclesman Wood, right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim, Cyclesman Wood. Tim, in previous interviews, you said inflation that we're facing right now isn't what you would call organic inflation, where wages are going up and food's going up and so on. But we're not seeing this huge spike in wages like we did when inflation was running rampant at the same rate back in the late 70s, early 80s, where mortgages were up to 18%. I got a 21% Canada savings bond then. So obviously interest rates aren't like that. Do you think is it the supply chain thing? And again, you're saying this is an artificial manipulation, perhaps just to get prices up, because other things that go up with inflation, like gold, for example. Last time inflation was like this, gold was going crazy, and it's been completely calm.
Exactly. You nailed all the points. Gold is not reflective of the inflation that we're seeing, nor are interest rates. You know, you mentioned the 18%, home mortgage or whatever you said. I mean, and I've talked about that, all year. Interest rates, and I think that's part of the engineering that they've tried to do in creating and holding. Well, I think it was multifaceted, everything is, but in holding short-term interest rates with these reverse repos, one, they didn't want them to go below zero, which they got really, really close. And that's when we started seeing the ramping of these reverse repos back in the summer, early summer. And then two, by having rates rise, you can point to the interest rates and say, see, interest rates are rising, so it's reflective of the inflation, but the rise that we've seen is minuscule. And so overall, rates are definitely not reflective of the inflation. So while I'm not denying the inflation, like I always say, I go to the grocery store too. I buy parts for my vehicle too. I get it. But I'm saying, yes, I think it's by and large, engineered and, a tool to point toward inflation to try to keep the game going, because if it's inflation, the economy's growing, everything's good, and it's exactly the opposite. I think that the inflationary prices that we are seeing are a tremendous burden on the so-called recovery, and it's going to lead to the inevitable, I think, collapse of the bubble that we've been watching.
Market historian Bob Hoy has pointed out, since the Fed was created on Jekyll Island back in the early 1900s, we've had 18 depressions or recessions. And of course, this time everyone is saying that mantra, this time it's different. Is this time different? Could the Fed prevent another recession?
No. This time I think they have created, once it goes, look, the actions that we have seen to keep this thing going, if you think about it, if we go back in time for 20 years, 21 years now, whatever, as I would argue, looking at the data, the market tried to roll over coming out of the 2000 top, and it did. It rolled over out of a 4-year cycle top. I forget what the percent decline was, 34, 30, whatever, 6%, whatever the number was. Been too long ago to remember. But we rolled over into a 4-year cycle low. And if you look at the hardcore economic data, you look at the job participation rate, you look at the volume characteristics of the market, you look at, I can't remember some of the other things I was looking at, but, you look at that data, it all peaked. Everything kind of corresponded with that 2000 top. But since then, the underlying theme, if you will, has been reinflation. Keep it going. Bridge the gap. And we saw those efforts into 2007, which created at the time what I call the longest, and it was the longest 4-year cycle in stock market history. They stretched that one. Okay, at that point, at that time, take yourself back in time, and in 2006 into 2007, that was the longest extended 4-year cycle in history, based on all these manipulative efforts to bridge the gap and keep things going. Well, it resulted in the worst financial crisis since the Great Depression. Okay, we go into the 2009 low, we come out of that, we had a few little minor corrections, they've managed to keep things going, they always come out and jawbone and game the market, and we see every trick in the book played, and it's just, since then it's been increasingly more artificial, if you will. Now, they've done a magnificent job at doing this and keeping things together, but in effect, they created a worse scenario. Now, nobody on the planet believes that anymore because it's gone on for so long. Everybody thinks everything's okay, and today their housing price is up, whatever for the year, and so you extrapolate that. Well, hell, next year it's going to be up again, and everything's great, and everybody sees the short term, and they just don't understand. I guess they just don't. I don't know. Nobody can look at history and understand that this is not a normal environment that we're living in. And I guess everybody has such short memories that they just can't see the forest for the trees. I don't know. I can't explain it. But that said, the answer to your question is that, as I see it, they've created, in effect, by trying to keep things together, they've created an even worse bubble, a worse scenario. So the high wire act I've been talking about, or the razor's edge, or however you want to say it, is the balancing act of trying to keep it going versus the consequences if you don't. And that's where we are, and that's how we got here. And so, yes, I think to that point, I think that he is correct. They have, by default, created a much worse problem.
Mm-hmm. Now, an article I read said hardly anybody on Wall Street is there anymore who remembers the rampant inflation we went through in the late 70s, early 80s. And, I'm old enough now that officially I should be retired, but that would be just too boring, wouldn't it? So I remember, because I was recently into the workforce back then. We used to get every 3 months a cost of living adjustment on our paycheck, like $130 extra. I don't see anybody doing that today. Ever.
No.
Businesses
no.
just
I
don't.
And that's what I'm saying. This is not the inflation that we're seeing is not based on a growing, expanding, however you want to say it, recovering. Well, I guess there is an element of recovery, obviously, but it's not an organic, long-lasting economic recovery, let's say, or expansion period like with the .com bubble. That was an organic. That was a real economic prosperity. That's not what we have here. That's the point. And the other point is that we've been in this environment for so long. It's like either people are numb to it or I don't know. Like I said, I can't explain the phenomenon. It's just part of the mania of the bubble, but it's like nobody gets it, nobody can see it, everything's fine, and que sera, sera. Everything's peachy.
Well, I know every time we are near the peak of a thing, I think 2008, the big mania was sports trading cards were going for tremendous amounts of money. Now it's sneakers and NFTs, non-fungible tokens, digital images that are being sold for thousands, millions of dollars. Again, it seems like people have to find some weird, fun way to spend any excess cash they might have. And again, all of those things will fall tremendously in value, or in the case of digital items, may blink out of existence. Exactly.
And I see it with everything, I say everything, collectibles. I see it with, like there's some cards, like playing cards, and I was at a shop and I saw some stuff. I couldn't believe the prices of some of this stuff. Vintage stereo equipment. I see it with vintage watches. It's just something that we talked about that before, that I know somebody has a jewelry shop, talking to them. It's in everything. It's absolutely in everything. And, to your point, I know people, everybody's got their opinion, but my opinion of Bitcoin, and you kind of made the point yourself, but it's not, how do I say this? In one sense, it's not even real. Hell, it's air. If the power goes out or the internet goes down, what do you have? Nothing. Nothing. You got nothing. Nothing. So I see that as part of the mania as well. This is all symptoms or signs of the bubble we're in.
Tim, is there any way to protect yourself in a time like this? As you say, we're living on the razor's edge.
I think that, people that are in the market, and I'm not giving specific advice here, but people that are in the market, like my old friend Kennedy Gamage used to say, it's certainly time to dance mighty close to the door. And, once it goes, structures in place, and we start to really see a downturn happen again. I don't think there will be any place to hide but on the sidelines, because I think, everything's inflated. Tell me something that's not. Housing prices. So, why would you want to own real estate? Commodity prices. I mean, like I said, we're seeing cracks there. Art, collectibles, antique cars. I mean, name something that's not overinflated in this bubble. So therefore, I don't know. I think the sidelines is going to be the place to be, and cash will be king in the deflationary environment. I mean, it certainly was in 2009, and like I said, I think this dwarfs that.
Tim, kind of a grim outlook, but something forewarned is forearmed.
Yes, it is, and I don't mean to be grim. It's just, like I said, the environment we're in. And I guess the other thing, like I said, it mystifies me. I don't even, that I guess maybe some people do see it, but they tend to not pay it a lot of attention, and I think a lot of others really don't see it. I mean, they think we're in a genuine recovery and everything is fine, and, the Fed's got this, and, they're gonna there's like the Greenspan putt. It's just, the powers that be have got this in full control and everything's fine. And that's certainly how we got here. And so far that's been the case. But the result and the bottom line is there's never been a bubble in history that hasn't unwound. They all do.
And what I find disturbing is we have banks and other institutions that have made record profits, don't plan to open more branches or hire more people or expand their businesses. Instead, they're buying back their own stock at record high valuations. And we know if there's a crash, they're going to go begging to the government for a bailout when they did have the cash on hand at one point to look after themselves.
Another good point. I agree, and I think that's wrong. And, talking about the recovery, not to make this interview any longer than it has to be, but remember back in 2018, 19, and into 20, pre-COVID, right before the COVID downturn, we talked about the economic growth numbers. We talked about the job creation, the real growth rate, looking at those job numbers. And I'm saying this cold. I've got it in notes somewhere, and I have the data. I can go look. I just don't have it at my fingertips. But the growth rate peaked. I think it was sometime in 2015. And so we're struggling to get back to those levels. The worst economic recovery since the Great Depression, and that's where we stood at that point in time, and it had begun to start to dwindle, if you will, and now we're struggling to get back to those levels, and we sit at that crossroads with an even bigger bubble. So that's where we're at as we move into 2022.
Tim, thank you so much for chatting with us. And despite the possibility of a huge market crash, if you've done your homework, you're prepared for things like that, and it could still be a great 2022.
Absolutely.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. All the best in the new year.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.